China's central bank slashing the amount of money that banks have to hold as reserves. It's the third time this year the bank has made this move to boost lending in a slowing economy. So let's talk about this. It's interesting to talk about it in the wake of talking about the Fed, right? Because one of the president's complaints is the Fed is not sort of getting his back on stimulus, whereas in China it's quite a different situation. Is it worrying that China appears to be slowing to such an extent that it needs to enact these kinds of measures?
Well, first of all, we've known for a long time that China was going to slow, and the growth rate's been coming down pretty dramatically over the last couple of years, so that's not a surprise. What is surprising is that they are using these tools to combat this extended trade spat as well, right? So they're in the same kind of pickle that we are, that the longer that the trade concerns are overhanging their economy, that potentially damages them as well. So they're trying to use their tools to also stimulate their own economies.
Was it that reason that your firm actually decided to do a little bit more with gold?
Yeah.
Or was it what we were talking about earlier, the disconnect?
Yeah, look, gold's a really interesting asset class here for a variety of reasons. First of all, it's one of the few things that gives you tail risk hedging, right? So if we hit a deflationary, recessionary environment, gold can tend to do pretty well. Conversely, if we hit an inflationary environment, gold can tend to do pretty well. I think the other thing is there's no cost to carry here. And with interest rates as low as they are, gold's a really interesting asset class to sort of calibrate your equity positions.
Back to the Chinese economy, do you think that they're freeing up, what, $126 billion from the banking system? Is that enough to kind of get China going? Because it's a massive economy.
Well, look, there are lots of things that are headwinds for sure. Manufacturing growth is clearly a headwind. So it's not enough in its own right. But I think that the point is that China's trying to use the tools it has available, even devaluing its currency to some degree. We used to talk about the 7 level as though it was sacrosanct. They would never violate it. And here we are.
Yeah, it's interesting, though, when you look at either the Fed or the PBOC, it's difficult to separate the trade war-induced slowdown, right, and just the underlying slowdowns that perhaps were already occurring. So when you look at their various tools to combat these things, it's hard to, there's no counterfactual, right? We don't know what it would look like without a trade war.
Well, that's absolutely right. And again, keep in mind that the growth trajectory for global growth period has been coming down, right? So we're not at the 4.5% or 5% global growth rates that we were. We're probably anchored more on a 3 handle. So that's the underlying backdrop. But then when you look at things like consumer versus manufacturing in the U.S. and you look at the divergence there, that gives you some signal about how the trade spat is hurting manufacturing.
All right, and real quick, we have a Trump tweet on China. China is eating the tariffs, billions pouring into the USA, targeted patriot farmers getting massive dollars from the incoming tariffs, good jobs numbers, no inflation, Fed, China having worst year in decades, talks happening, good for all. We would love to keep talking about China with you. You're going to be here the whole hour, so maybe we can get this back in.